Welcome to the 3-Edge Week in Review for the week of January 2nd, 2023. I'm Fritz Folts, the Chief Investment Strategist here, and joining me once again is Steve Cucchiaro, CEO and Chief Investment Officer here at 3-Edge Asset Management. Before we get started, I do want to say on behalf of everyone here at 3-Edge, I'd like to wish all of our listeners the very best for the new year. Today, Steve and I will be discussing how even after last year's approximately 20% decline in the S&P 500 index, according to our model research, the S&P remains significantly overvalued. However, there may now be early signs of potential investment opportunities in some equity markets outside the U.S. A quick look back at last year, which the Financial Times, I think, aptly described as the year that ultra-low interest rates and quantitative easing died with the arrival of high inflation. By the end of last year, the S&P had declined by just under 20%. The more tech-heavy NASDAQ composite was down approximately 33%. And one interesting and potential fact about the equity markets last year was the high water mark for the S&P in 2022 was actually the first trading day of the year on January 3rd. And what made last year so painful for many investors was that with the onset of inflation and the commensurate increase in interest rates by the Fed, U.S. Treasuries did not serve, as they have traditionally, as a hedge against declines in equities. In fact, U.S. Treasuries experienced their worst year of investment performance since 1949. This combination meant that last year was the worst year of performance for the traditional 60-40 portfolio of 60% stocks, 40% bonds since 1937. In total, last year served to wipe away approximately $30 trillion in wealth. As we put 2022 into the rearview mirror and enter the early days of 2023, investors seem to have more questions than answers. Questions such as, how fast and how far will inflation come down in 2023? Will the Fed be able to engineer a soft landing for the U.S. economy, or will the U.S. economy dip into recession this year? And what will the impact of inflation and higher rates have on the outlook for corporate earnings? Now, this week, we got some potentially good news in regard to inflation. The Bureau of Labor Statistics reported that the U.S. economy added 223,000 jobs, which is, that's a strong number. However, it's the slowest pace of job growth since late in 2020. So maybe an early indication that hiring, although it's strong, may be cooling. And perhaps more importantly for the Fed, Friday's report also indicated that average wage growth had slowed more than expected in December. And a slowdown in wage growth would certainly be welcome news to the Fed as it continues to battle against inflation. So, Steve, let's get started. Let's bring you into the conversation here and see if we can shed some light on what investors might expect this year. And let's start with, it's kind of interesting to think about the fact that even after this 20% decline in the S&P, which I mentioned earlier, our model still finds the S&P to be significantly overvalued. So maybe you could just explain why that is the case.
Yeah, so we find that price to sales ratios are perhaps the most effective valuation measure. They've been outstanding predictor of future returns. They've been very reliable and have worked well as a valuation measure over decades, in fact, over more than a century. And so we really take them seriously. And if we look at the chart, what we'll see is that in 2021, when the market was raging, we had a situation where valuations were unprecedented. We had unprecedented overvaluation caused by the massive money printing, by the interest rates near zero, by all the trend following and the market mania that really peaked at the end of 2021. And we saw a price to sales ratio that was higher than ever before in recorded history. Now, as you mentioned, the stock market in 2022 declines almost 20%. And so we go from an absolute record overvaluation to still excessively overvalued, despite that 20% decline, as you can see on the chart.
So, okay. Now we have U.S. equity markets significantly overvalued by our measure, but our model research and our investment committee, we are seeing indications for potential opportunities in non-U.S. equity markets, So maybe you could describe what those factors that look a bit more favorably towards non-U.S. equities would be.
So when we think about the last decade, even more than a decade, the market mania was really focused on the U.S. and it bypassed much of the rest of the world. And if we look at this chart, we can see since the last financial crisis, the degree to which the U.S. outperformed the rest of the world is not justified by any fundamental data. It wasn't that U.S. had profit growth that justified that kind of outperformance. It wasn't actual sales growth. There wasn't anything about cost of capital. The U.S. markets just left the overseas markets in the dust. And a lot of the market mania was focused in the U.S. So that's one reason why the overvaluation really hit the U.S. and not so much the rest of the world. And so one way to look at it is, while there's bad news everywhere, and no one's immune, that the international equity markets, because they were never overvalued, are much more reasonably priced for the bad news. Also, in some emerging markets, they took inflation more seriously earlier on. They weren't like our Fed saying inflation was transitory. They began raising rates in anticipation of inflation problem much before us. And now some of them are actually able to start lowering rates and their inflation rates are coming down. Also, when the US dollar was rising sharply, that is really harmful for emerging markets because they borrow a lot of money and get a lot of loans in US dollars. So when the US dollar stopped rising and started to stabilize or even come down a bit, that's been big relief for emerging markets. So we see emerging markets as an interesting opportunity where there's not a lot lower they can go. They've so underperformed for the last decade. And there are some signs that there's some interesting undervaluation measures. Now with Europe, we have a bit different situation where a lot of bad news is focused on Europe, but the European stock markets reflected a lot of the bad news. And a lot of their inflation problem is due to energy. And energy prices have been coming down. European inflation has been coming down more than expected. And yet still the valuations in the stock market, they are pricing some really bad outcomes. So again, we can think of Europe as perhaps closer to a bottom than a top. And we can see on this next chart that it does make sense to look outside just the U.S. for equity opportunities. The pendulum does swing. You can see decade by decade. Some decades the U.S. outperforms, some decades U.S. underperforms. Perhaps we're due for this pendulum to swing back.
Excellent. Great. So as always, my final question is, based on what we've discussed here today about the U.S. market and its overvaluation, more attractive valuations outside the U.S., how should investors be thinking about their investment portfolios in these early days of 2023?
Well, despite the fact that many Wall Street analysts are calling for a big bounce in the stock market because last year was so bad, we think it's premature to count on that in the U.S. We think that the bear market in U.S. stocks remains intact for now. And one reason is because it's still overvalued by our measure. Another reason is that the Fed is still tightening. And the third reason is that the S&P 500 index is still below that 200-day moving average we've talked about. And every time it seems to hit that 200-day moving average, it fails. And behaviorally, that's not a positive thing. So until those different factors I just mentioned change, I think it's more prudent to consider that we're still in a bear market. And in fact, we have a big test coming up. We're going to find out about corporate earnings in Q4 over the next few weeks. We'll see earnings announcements. They might be better than expected, and that could cause a rally in the U.S. stocks. But if they're worse than expected, that could be phase two of the bear market, and phase two of three phases, and we could see another leg down. So I would say that relative valuations support some rotation or reallocation from U.S. into emerging markets in Europe. And while we still have a cautious low allocation of equities generally, right now our models are showing that half or more of your equities should be outside the U.S. to take advantage of the relative valuations. When it comes to bonds, because we're still not in a recession, but it could be that the recession has just been delayed because of all the fiscal stimulus, and that could still happen later in the year. If we do get a recession, we could see credit spreads widening. So we say that it's still important to stay focused on highest quality bonds. That's usually government bonds. And because there's no guarantee that long-term interest rates may come down any lower. In fact, if inflationary expectations start to rise, we might see long-term rates start to rise again. We still favor short duration treasuries and also TIPS, Treasury Inflation Protected Securities, where you can earn today, unlike a year ago at this time, you can earn a 1.5% real yield over and above inflation. And then finally, we think that it's time to start adding a little bit more to gold. And the reason why we say that is despite the potential for short-term headwinds if the Fed keeps raising rates the next few weeks, we think that there will be a limit as to how far the Fed can raise rates ultimately because the government debt is now over $32 trillion. The interest expense is going to be so great and so painful that they might find, like they did back in the 1940s, that there's a limit as to how far they can push the interest rates up. And then that would be very positive for gold.
Excellent. Well, thank you. Thanks for your insight. Looks like 2023 could shape up to be another interesting year, another challenging year in the markets. And so we'll just continue to do our best here, Steve and I, to give you our analysis and to let our clients remain informed about whatever may be going on in the economy and the global markets throughout 2023. So that will do it for us for today. On behalf of Steve and everyone here at 3 Edge, thanks for listening.